Hello, you're welcome. In this video, we are going to be building a leveraged buyout model together. And this is going to be on a single sheet, just as we have here. The model is going to contain different FX conversion parameters, dollars, euros, and pounds. It's going to have three cases, worst, base, and best. It's going to go across 6 years before we finally sell. So let me just expand each of this so that we look at how this was built and what went into building this very model. Then we now build ours starting from the beginning. So from the top here, you see that data validation data allows us to select the FX conversion parameters. So we are able to select the kind of currency we want to work with, whether we want to work with dollar or euro. As you can see, there is a change instantly, but the equity IRR still remains the same, and these other ratios still remain the same, but in other numbers here are changing. So if I do for pound, if I change this to pound 2, you can see that the numbers are changing here, but the equity IRR is still the same, as well as other ratios that we have here. We can also change our cases. So here we currently have the base case. If we change it to worst case, you will see that our equity IRR immediately changes. Our best case, you can also see, which is showing us that this very model is smart. And it is this kind of model that we are going to build. We are going to build exactly this actually. So let's see how this will work. So here you can see we started with our scenario cases. Let me expand this, and you can see from the scenario cases, we have worst case, base case, and best case, and we are using the exit multiple and the interest rate to determine our cases. Then for our currencies, we have a section here which actually deals with the rate of the selected currency. So you can see here we have 0.74 here because the currency we've selected is pound. However, if we change this to dollar, it becomes 1.00, which is the default. If we scroll down here, you see that we have years 1 to year 6, this very model building. The year 0 is the initial year when we were making acquisition of this company. Then we have different ratios that came about during the course of the building of this very model. Now we can see the value we purchased the company for. You can see the purchase price for the equity. You can see the exit EV by EBITDA ratio. We can see the exiting cash deployed. We can see how much we collected as debt to fund this very project. Now, next thing that we see here is our initial balance sheet. So this is the balance sheet at the start of this very acquisition. So you can see what we have in our assets as well as what we had in the liability. So these were before the acquisition. And all these you can see are in blues because all these are assumptions. Okay. So now when I move down, you see that we now start making calculations, and this time around using formulas. And due to all these linkages and formulas, we now start using black color. And here you can see we have the acquisition summary section. We have the sources of funds and the application of funds, telling us what we use the funds for and how we got these very funds. Then we get to the section where we talk about our goodwill, which is the premium we paid to purchase this very business. So we paid a premium which we normally see as other benefits that come with that very business, and that is why it becomes more expensive than the normal price that we're supposed to pay for that very business. And what we have on top is what we call the goodwill. Then we now build our pro forma balance sheet, which is the balance sheet immediately we were able to acquire this very company. the current status of the business instantly after we acquired the company. Then we move to the debt schedule, where we now schedule how we pay our debt from the first year down to when we finally sell the business. We have our working section, the EBITDA and capital expenditure, and here we are able to show how we terminate this very business, the terminal multiple we use to sell the business, as well as the very amount we finally sell the business for. We have the plant balance, depreciation, and other asset module, where we show the breakdown of our assets. We deduct depreciation to get the net book value for our assets. And finally, we move to the financial statements, starting from our P&L to get the earnings, then our cash flow to get the cash that we have in the business, as well as calculate the equity IRR, get the cash flow for equity, then get our balance sheet created, where we now have our total assets, total liabilities, and equity. And then here we now see that we use conditional formatting to ensure that our asset is equal to our liabilities plus equity. If we come to this uncompleted exercise, you can see that we have it here still as red. So if we complete this very work and we are successful, then this should also become green. Let's get started with this very exercise. So we start from this very uncompleted exercise and we start from the beginning. So if we scroll up here, the first thing that I want us to do is to actually create these scenarios as well as the alternative currencies so that we take it up from there. So I will start by creating the scenario cases. So I'll enter scenario cases here. So the first is the worst case. Then we have the base case. Then we have the best case. Then here we have exit multiple and interest rates. So the exit multiple and the interest rates, the values for each of these will be what we'll use to get our worst case, our base case, and our best case. So our assumption is that for our worst case, the exit multiple is 6.00, and we have it as blue since this is an assumption. Then our interest rate for the worst case is 8%. Our base case, the assumption is that we are having a 9.0, and then for our interest rate, a 6.50. Then for our best case, our assumption is a 10.0, and for the interest rate, a 5.0. Next, we move to the alternative currencies. So for this, we are going to have a section for our selected rates where the selection we make will appear. So this will be called selected rate, and the selection we make will appear here. What are the currencies we want to use? We are starting with the US dollars. Then let me insert the symbol. I come in here, selecting this, and then select US dollar. Then the next we are going to have here is euro. I also come to this symbol and select euro symbol. Now here, these are the currency rates that we are using. As at the time we're making this video, the currency rate, since the default that we're using is US dollar, it's going to just be 1. And then for the euro, we use 0.86, a pound 0.7. Now, we are going to create conditional format here and permit selections for each of these. So let's start with we getting this very color. So I will come to this. I'll now create conditional format by coming to this data, selecting this data tools, and then data validation. I will select here where I have sources. I'm going to select this, and you can see I have option to select this, but it's not yet active. Then let me come to this scenario and also create data validation. From this data, I come to data tools, select data validation, lists, and then select these cases. So I can easily select any of these cases. Let me leave it as base case for now. Now, here we have this selected rate. I'm going to be using H lookup, make this very FX conversion parameter, and thereby also displaying rate that is being selected based on the currency we select. I'll use H lookup. So my lookup value is E1, and I will lock it. Then my table range will be from G13. So I will need to also log this. Then my row index is 1 and 2, the second one. So I enter 2 here. And then my range, since I want the exact value, I will just enter false here. So you can see the selected rate now is this dollar, 1.00. So if we change this to euro, you can see it automatically changes now. And to pound, it still changes. And let's also make this base case active. So to make the base case active, to use HLOOKUP for our exit multiple assumption and our interest rate assumption, I will scroll down to where I have this exit multiple assumption. And this is where I have my exit multiple assumption. So here I will use the HLOOKUP as well. So I will start with HLOOKUP, and the lookup value, this is it. And I will log this. Then my table range, I will still log this. My row index, since I'm working with this exit multiple, it is 2. That's 1, 2. And I want exact match, so I will take false. The next is to get for our interest rate. I will scroll down to where we have the interest rate, and here I will enter the interest rate by the HLOOKUP function and then select the lookup value. So it's still in this base case, and I'll need to log this. Then my table array, let me log this as well. So this is supposed to be G. Then the row index is 1, 2, 3. So it's 6.5. I expand this, I think let's be sure of our selection for this. So this one is also supposed to be G. And what I will do is just copy this through. So we are using the same interest rate to pay our debt from the year 0 to year 6. And that was why I just copied this through. Now, next thing that I want us to do is to create named ranges. So the first named range that I want us to create for this selected rate, so we are going to call it currency rate, as you can see here. So we just enter this currency rate here, make it currency rate. We are going to create another named range that is going to be for our exit multiple, call it exit multiple. Then we also create named range for these interest rates. We are going to also be getting outputs here. So let me enter outputs. And the first output that we need here is our equity IRR, EV by EBITDA, which is our exit multiple, our debt bar. So all this will reflect after we've gotten to this stage. And you can see that this based on worst case is now active, as we can see here. And let's enter the remaining our assumptions. So for our purchase price for equity, we are assuming 40,000. That's how much we are paying for this very business. Then our exiting cash deployed, 575. So this is what we have in the business before purchase that we also use for this purchase now. It's already existing in the business that we are purchasing, and so it is now part of. Then for our fair value adjustment for fixed assets, it's going to be 12,890. A fair value adjustment for receivables, 980. Remember, this is a company we are acquiring, so things will exist before the acquisition, and some of them will have to touch the values, and this is why we are having all this. Then our term loan raised. This is how much we borrowed. to be able to make this acquisition. So we are assuming 12,000. Then our loan tenure, we want to pay back our loan in 6 years. Let's get our EBITDA forecast. EBITDA looks like in the first year, 4,367. This is for the year 0. And then for the first year, we are assuming 4,567.00. Then next, we are assuming 5,199.30. Let me just enter the remaining. And you can see that we have a steady increase in our EBITDA forecast from year 0 when we make the acquisition to year 6 when we finally sell off this business. Then for our capital expenditure, we are also going to enter this. So these are the investments we make. Now let's get our working capital requirements. So we are going to assume a 12% working capital requirement across. That's the percentage of our EBITDA. Now I'll copy this through. Next, we are going to get our corporate tax rate. And in this case, I want to use 25% throughout. Then for the asset depreciation rate, 7.5%. These are the information we have for our balance sheet, our initial balance sheet. The available cash at hand is 3,575. We have account receivables and long-term assets. And for our debt obligation, and these are all the assumptions that we have, which we are going to use for this model building. Now, one more thing, since we are going to be converting these very currencies, we need to link these our selected rates with our various assumptions here, all those that concern the currency, so that it can easily change as we change. For example, we start with this purchase price for equity. For this purchase price for equity, we are going to multiply it by our currency rate. Let me just select it from these named ranges. So we are going to do this for all that concern currencies. So if you noticed, we avoided this 9.0 since it's just. We're also going to avoid percentages. And finally, we have successfully linked all of this to the currency rate so that as we are changing the currency, we are getting the value based on the currency selected. So we are done with assumptions and we are going to be moving straight into performing the model building, starting from our pre-transaction EBITDA. So my pre-transaction EBITDA, I will find it in this very place. So I bring it down. I've linked it. Next is the debt raised. So the debt raised, you can find it here. So this is where we are trying to get our acquisition summary, what led to the acquisition. And then let's get our equity investment. So equity investment is up here. And then we add our net debt or cash. So that one going to be, these are our debt obligation, available cash. So this is the formula to get our net debt. And to get our enterprise value, the enterprise value, the formula is always equity investment net debt. So I will just do sum of this will give us our enterprise value. And let's get this divided by EBITDA, which is our acquisition ratio. So the EV that we have here is this enterprise value divided by EBITDA. Then our debt to EBITDA, you can see the debt raised here, and our EBITDA. Now we come to this our output and we link each of them. So we start with this equity, we also link the debt to EBITDA. So this equity IRR, we are going to get it when we finally reach the stage for our cash flow calculation. Let's progress. So we move to our sources and application of funds, where we enter what we use the funds we got for, as well as the sources that provided us these funds. So let's start with application of the funds. So the first thing that we used our fund for was to purchase, this very business. the amount we used to purchase it. We also paid off existing liabilities. So what was remaining to be paid when we acquired this business, this debt obligation of 3,970. So we paid it off. Then the total amount we applied. Now, these are the sources of our funds, okay? But the total application of our funds should be equal to the total sources. So we just link this first. Then we start with our existing cash contribution, which we are going to find here, available cash. And then we get our debt financing, how much debt we use to finance this very acquisition. The remaining part of these sources will be the shareholder. So we already have the cash and the debt that we collected. Now, any other thing that will be funding this will be what the shareholders have been able to put together as equity for us to fund this very acquisition. So what I will now do is to enter this total source minus the debt financing minus the existing cash contribution. And this gives me the shareholder. Now we go next to our goodwill analysis. So for the goodwill analysis, we start with our acquisition cost. How much did we buy this very business? And we can see from here that we bought this business for $40,000. Then we less our our book value of equity. So I will just enter minus here, then get the book value of equity, which is this shareholders' equity. Then I'll also deduct my PPE adjustment. I can say this is the PPE adjustment, then the receivables adjustment. Now, when we total this, we are going to get our total goodwill. What we are going to do next is to prepare our pro forma balance sheet, which is the balance sheet immediately our acquisition took place. So the first balance sheet was before this acquisition, this initial balance sheet. Now we are going to prepare our pro forma balance sheet, which tells us the current status of the business immediately we perform this acquisition. So let's get our surplus cash. So for this, we are going to move up here, and you can see it here. And for our trade debtors, you can see account receivables here. Select this. For our fixed assets, this is it here from the previous balance sheet. Subsequently, we enter whatever changes that have taken place in the business. So we used up cash because of this acquisition, okay, the cash that we initially found. And that cash, we are going to enter it here. So this our total adjustment is going to be the sum of from these assets right up. Then for our pro forma, going to be this current, the total adjustment going to be hit down. Then we go to our trade debtors, the changes that have taken place in the trade debtors side. So if we come up here, we can see that for our account receivables, we were able to perform fair value adjustments. Okay, so we enter it here. Let's copy this down. And for our fixed assets, we can also see here that we made fair value adjustments for the fixed assets. This reflects in our pro forma. Now, for our goodwill, we are going to enter it here and see the value that we got for our goodwill here. So we link it here. And then what we are going to do here is to take the summation for each of the columns, then copy through. So let's go to the debt and equity section. So for our total debt, we get it from debt application. Then our total equity, we are going to get it from, now remember we retired our debt, okay, as you can see from here. So we paid off existing liabilities. We also received, so if we scroll up, you will see we received new loan here for our debt financing. Let us sum this, then take the summation of this plus the total adjustment. Now, coming to our equity, we actually removed equity for this very acquisition. So let's get this removal. So if we scroll up, so this equity removal is here, okay, and we now added new. So let's scroll up to where we added our new equity. That's this shareholder contribution. Is the new equity we added. We total, then copy this through, and you can see that this is balanced. So this is the pro forma balance sheet, and this is the current status of the business immediately we performed the acquisition. Now, we are going to move into our debt balancing. Okay? Already, you can see that this our FX conversion is now working properly. Okay? Everything is working properly here now. Base case and worst case, they are all interactive. So for this, our debt balancing, I think we need to fix this year's. And let's just leave it though. But you can see that our year 0 is in the end column, okay? And then we continue from year 1 down to year 6. So it's easy to understand. There's no need fixing it. So when we come to this, our debt balancing, we start with our debt term. And for our debt term, we are going to get it up here in our assumption, this loan tenor. And then the interest rate, we're still going to get the interest rate from the assumption up here. We copy this through. So we got new issues of debt. Our opening balance is actually 0. So we added new loan. As you can see from our assumption, we added new loan here. This was a loan we raised. And then for the initial year, our repayment was 0. Okay, so we still have 0 here. And then our closing balance, each of these, and then we copy through. Then for our opening balance here, for the next year, the closing balance for this year, which is our acquisition year, is going to be the opening balance for next year. So we just enter and then copy through. Now, here where we are supposed to add new issues, we did not add any other, okay, so we just copy through. Then here we are going to enter our repayment. So you can see that for our repayment, we are going to be using this opening balance to get our repayment. So here we use the formula minimum. So this negative is just to ensure that we have the less symbol here, the less sign, okay? And then the number that we're selecting here is 0.99. So depending on which one is the minimum, either it or the division of the 0.99, this time around, I will log this divided by this my loan term. So that if we are copying and the value is now less, it's going to return the minimum value. That's why we have that minimum. Then I copy this. Then we are going to calculate our interest on opening balance here. So this is going to be N99 times 6, okay, as based on the interest rate multiplied by the opening balance. And then we copy this through. This gives us our debt schedule. Then we move to our working capital. So we are going to be starting with our EBITDA projection, the acquisition year, and then we copy through. So our EBITDA projection for the acquisition year is here. Then we copy through to the last year, which is the year we sell off the business. And then our capital expenditure is also available up here. Also copy this through. Now let's get our change in working capital. Our change in working capital is equal to our EBITDA projection for year 1 minus the projection for year 0. Then we copy this through. Let's get our working capital percentage, which we can get from our assumption. Also copy this through. Okay, here we are going to get our change in working capital. So to do this, we are going to be multiplying this by the working capital percent. We copy this through. Here we start with our opening balance for the working capital balance. So to get our working capital balance here, let's just start with the closing balance. Okay, so our closing balance is equal to, then the closing balance for year 0 is going to be the opening balance for, just copy this through. Then I'll add the changes. Okay, this is supposed to be here. Let me add the changes here to copy this through. Now, let's get our terminal multiple. So our terminal multiple is up here, which is this exit multiple. And then to get the final amount to sell this business is going to be this terminal multiple multiplied by the EBITDA of the final year. So that is this final multiple multiplied by the EBITDA of the last year when we are going to make our sale. Now we move to our plant balance, depreciation, and other asset module. Here we are also going to start with the closing balance. So for the closing balance, we get it from the pro forma too. So I'll move to my pro forma, select it here. So the closing balance for year 0 is going to be the opening balance for year 1. So I will just select it and then copy this one through as well. And let's add our capital expenditure, which we have already calculated, and is also, we have already entered it in the assumption, okay? So I will just come to this assumption and select the capital expenditure. Then I will less my proceeds for sales. So I did not make any sales throughout except in the last year, okay? So I will just enter 0. So I'll enter 0 from here, and then here I will enter the value we sold the business in the final year, which is this $69,249. Then add this through. Now, our depreciation rate, we can get this from our assumption. So we move to our assumption. This is our depreciation rate. Then our depreciation expense, which will now be our opening balance here, multiplied by the depreciation rate. Our accumulated depreciation is going to be this from our pro forma. Then is going to be equal to what we have here added to the next year. We copy through. Now we move to our financial statements. Now financial statements, we are going to be starting with our EBITDA. So let me get the EBITDA for and copy through to year 6. Now less my depreciation. So here we have depreciation, so we less depreciation here, and we copy through. And when we add this, we are going to have our EBIT. And we less interest expense, so our senior debt, the interest expense on it, we are going to less it here. So let's get it. Then let's get our EBIT. So that will be equal to our EBIT plus copy through. Then let's get our, because we are going to be lessing the, so to get our book tax is going to be the tax rate. Let's get the tax rate from our assumption. This is our tax rate. Then we multiply it by EBIT, the earnings before tax. We copy this through. Then we add our EBT to this, our net profits. Now let's go to our cash flow statement. For our cash flow statement, we are still going to start with our EBITDA. We copy this through. Then let's add, we are going to less the working capital change. So we've already calculated this working capital change. So we look for it up here. Then I copy through. Then we also calculated this tax, copy this through. Then we add this to get our operating cash flow. It's supposed to be, okay, it was initially in the negative form, so let's just copy it. We copy this through. Now we less our capital expenditure, which we have already gotten. So we go up to where we have our capital expenditure, then we copy this through. Then next is our asset purchase. So for our asset purchase, we are going to be moving straight to our pro forma balance sheet. Not the pro forma balance sheet. That should be, okay, our sources of funds. Yeah, our sources of funds. And this was in the very year we performed our acquisition. Since then, there was none. So just enter 0. Then sales from proceeds, as we recall from up here where we made our proceeds. So let me get it here. Then I copy through. And now we are going to get our cash after capital expenditure. So to do this, we just add the sum from here to here, copy through, and we add new senior debt. So if you remember, we added new senior debt now year 0. So we go to that point of $12,000. And our equity issued, we can also get it as shareholder contribution. And our surplus cash for use. This is the available cash for use. Let's sum it. This is our cash for waterfall, and sum it and get this of our final. Then we less our senior interest. This we have already calculated. So I will just find it here where we performed the calculation for our senior interest. As you can see here, and link it here. We also less our senior repayment, the repayment of the debts we calculated earlier, and we go up to where we performed this. Now let's get our net cash flow. This is going to be equal to sum. We copy through. Now equity distribution equal to each of these net cash flows. We are going to get our cash flow to equity and then use that to calculate our equity IRR. So here I will get it by linking this my equity issued. Okay, so this is for the year we performed this acquisition. I will now link the equity distributions from year 1 to year 6. Then use this to get my IRR. So I use the function IRR, select each of this. Let me link this to this very output. So my final IRR here is this 20%, which will enable us to make investment decision. Then we move down to continue with our equity balance. So we're going to be starting with the closing balance. Okay, and this will be from our pro forma. And then the opening balance for year 1 will be the balance from the acquisition year. Then we copy this through. Now we are going to add our equity advances, which in our case is 0. We copy through. Then our net, let's get our net income from up here. It's our earnings. Then we less our dividend. This is our dividend. Now let's add this to get our closing balance for each of the years. Now we are going to prepare our balance sheet here with our assets. So let's link this from our pro forma here and then our cash. So this is actually supposed to be what we are linking. I linked it to assets. It's supposed to be the cash. Then our working capital, you can see our working capital here. We copy this through, and then our fixed assets. So this is our fixed assets. Let's get it from, I also copy this through. Then you remember we calculated our accumulated depreciation. So let's this accumulated depreciation that we calculated. So we scroll up to where we calculated this accumulated depreciation, and this is it. Then we copy this through. Then let's get our goodwill. So our goodwill, we are going to get it from our pro forma. So we scroll up to our pro forma here, then select this. Then we equate this so that we have the same value for the entire goodwill. Then let's total this balance sheet. Take the total of this balance sheet. So for that, we are going to have our sum. Then we select from here down. Then we copy through. And then we are going to link our senior debt here. So our senior debt, we get it from the top here. We have already calculated the senior debt. So we get it here. And then we copy through. And then we also get our equity value. So our equity value, we are going to get it from here. Then we also copy this through. And let's get the total of our senior debt and equity value. So we sum our senior debt and equity value here and then copy through. Now what we are going to do next is our balance check and see if our total for asset is equal to our liability plus our equity. So the formula we are going to be using is round. We select round so that we have the rounded number and avoid having, then we select for our total assets here, round to 0. This, and the number of digits is 0. And then we equate it with another round. This time around, it will be the total for debt and equity, and it is also to 0. And you can see we have through showing us that it is balanced. So we copy through and everything is true. And we have successfully been able to replicate what we had here. And when we look at this, we see that it functions effectively. Our IRR remains the same as the currencies are changing. As we change our base case to worst case, you see that our equity IRR is changing, as well as for the best case, it also changes to a higher value. And this will enable us to make investment decision and know if this is really a good investment. But seeing this 20% equity IRR, it shows that this investment is really worth it because we are going to surely have a good return. A debt to equity to EBITDA ratio of 2.75 is still good, showing that we are leveraged, but not so much that we cannot be able to pay. So we can be able to turn over and pay off our debt within 3 years. And for our EV by EBITDA, that's our exit multiple now of 9.25. That is actually a very good investment since we are going to be selling at a multiple of 9. Surely going to get a return for our investment. And these are just the few components of this model that are important, and we have successfully been able to build this to completion. I hope you've been able to find this video helpful. Please, if you have, kindly like, share, and subscribe to our channel. Thank you, and I'll see you in the next one.